Good morning, everyone. This is Marshall Gittler bringing you the morning comment for October 17th. A week ago, St. Louis Fed President Bullard said that the markets are making a mistake and that rates would rise earlier than people think, probably at the end of the first quarter next year. Yesterday, he stunned the market by saying that the Fed should consider continuing with its bond buying program, which is scheduled to end this month. This is the first such suggestion we've had from any Fed official. Paradoxically, he still sees the first rate hike at the end of the first quarter, on the expectation that the current global market turmoil won't affect U.S. prospects. Nevertheless, his suggestion opens up the possibility of delaying a first rate hike if things don't work out as hoped. Despite Bullard's comments, the implied interest rate on Fed funds futures actually rose 4 basis points in the long end. This may have been because of the generally good U.S. economic data, such as lower jobless claims and higher industrial production. Now, Europe and the ECB present a striking contrast to the U.S. and the Fed. ECB Governing Council member El Nowotny said the Eurozone economy, quote, isn't in deflation yet, but it shows clear signs of a weakening, unquote. Nonetheless, he said expectations of a large-scale asset-backed security purchases were exaggerated, and that the purchases wouldn't start until December at the earliest. Eurozone peripheral bond yields are soaring, a potential disaster when inflation is falling. Meanwhile, the spread between German and Japanese 10-year bonds is down to 33 basis points, meaning the market thinks Europe is turning Japanese. The market's clearly demanding that the ECB do something, but some ECB members see no urgency. The burden of rescuing the global economy, therefore, depends largely on the Fed. Money is not only flooding out of Eurozone bond markets. Yesterday, there was a record outflow from U.S.-based European equity funds, too. Such capital flows are likely to be one of the main factors driving Eurodollar lower, in my view, as investors get increasingly fed up with the Eurozone's inability to manage their monetary union. Now, oil bounced back after falling below $80 a barrel yesterday on speculation that OPEC will restrict supply in order to shore up prices. Given the fighting that's going on in the Middle East, I doubt that they'll cooperate on this, and personally, I see oil prices falling further. As for today's indicators, we have a relatively light day today. No major indicators from the Eurozone or the UK. There are several more ECB speakers scheduled for today. ECB Vice President Constancio, Bundesbank President Weidmann, and ECB Governing Council members Kur, and once again, Mr. Nowotny. In the US, housing starts and building permits for September are forecast to increase. Last time, both of them missed expectations and disappointed the market, sending the dollar lower. If the forecasts are met, it would suggest that the U.S. economy is on an upturn, and this could strengthen the dollar further. The preliminary U of M consumer confidence sentiment for October is also coming out. The big event in the U.S., though, will be a speech by Fed Chair Janet Yellen at the Boston Fed, who is having a conference on inequality. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.